Hello everyone. For chapter 7, I will skip the variable costing and absorption costing and go straight to the segmented income statement, as this is more related to the contribution margin income statement we covered in chapter 6. A segment means can be a division, can be a store, or can be a department, can be a product line, but it is a partial operation of the whole company, and normally is a profit center. Okay, means the company's profit is coming from these different segments. The income statement for each segment is similar to the contribution margin we used in chapter 6, but the key difference will be the fixed cost. We will separate it into traceable fixed cost and common fixed cost. Because when we look for the different segments inside the same company, some fixed costs happened for the entire company or some of the segments, but not for one special segment. Some of the fixed costs incurred only for each individual segment. So when we prepare the income statement for each segment, we really needed to be very clear which fixed cost is directly traceable to the department or to the product line, or which cost is common to all of the divisions. Because you only hold the managers to be accountable for the fixed cost, they can control which is the traceable cost. So let's see the more discussion of the concept and then go see the example. The segment, as we just mentioned, is any part or activity of an organization about a manager will seek cost, revenue, or profit data. So either income or profit center. So means the managers of this segment, they are accountable for making revenues and the cost incurred and the profit. For segmented income statement, there are two keys to build their income statement. First, we must use the contribution margin format rather than the traditional absorption format income statement. Because for variable and fixed cost, we can track the contribution margin by each segment and compare their performance, which cannot be done using the traditional product cost and period cost separation. The second also is the further separation of the traceable and the common fixed cost, because that's also related to clear up the responsibility for the segment manager. Examples for traceable fixed cost. So these costs arise because of the existence of this particular segment. If the segment stops to operate or disappear, then this traceable fixed cost will disappear as well. So such as a product line, the product manager for a special line like Fritos in PepsiCo, which is a real world company. So if we stop the production of the Fritos, and if you can get rid of the product manager, so the salary of the product manager will be a traceable fixed cost to the Frito business segment only. But given we will get rid of the position, the product manager position. Also, the maintenance cost for the building in which the Boeing 747 are assembled is a traceable cost for the whole 747 product line business segment, right? So they may have 777 or 747, so different the product models. So the maintenance cost for building especially for this model is a traceable fixed cost to the 747 model only. The common fixed cost on the other way arise because of the overall production of the company and would not disappear if any of the particular segment were eliminated. Means they are unavoidable. Okay, if you can use another word. So unavoidable means unavoidable for the whole company, or company-wide. And the traceable fixed cost is avoidable if we eliminate that particular segment. So such as the salary of the CEO for the GM, or the company-wide CEO. His salary will be a common fixed cost for all of the production divisions of the GM cars. So in that case, similar to the Frito, like the PepsiCo, the CEO for the PepsiCo company will be a common fixed cost to the Frito product line and like the drink, the Pepsi, like the Coke, the beverage line. So the general manager's salary is a common fixed cost to the different product lines. In another situation, the cost of heating a Safeway or Kroger grocery store is a common fixed cost for the various departments under the store operation, such as your pharmacy, your produce, your electronics, right? Or like dairy or the meat and the seafood. So the general heating or other utility cost will be common fixed cost if you want to looking for the segment performance for the different departments. The key thing we separate the traceable fixed cost and common fixed cost is when we prepare the segment income statement, we only put the traceable fixed cost under each division or segment. The common fixed cost will be listed under the company-wide or like the whole, rather than we allocate to the different segments. Even you allocate, but you should keep in mind the net income you deduct the common allocated fixed overhead is not the true income. We should use only the segment contribution margin to evaluate their performance. So now let's see this the book example. Okay, then we will check how we can make correct decision based upon the segment income statement. We develop a new term, to new margin we call segment margin. This is in another way we can call segment income, right? So either margin is the net income made by each segment before we deducting the common fixed cost. For segment margin, only the traceable fixed cost is deducted. So now let's see quickly this example. I think we will understand better. We have a company, Weber has two divisions or two segments, computer and television, like electronics. So let's look more closely at the television's income statement in terms of the contribution format. For the television, we have a total sales revenue 300,000. Then all of the variable cost of goods sold. So variable cost of goods sold only include your direct material, direct labor, and the variable manufacture overhead. Then minus other variable expenses will be your variable selling and admin expenses. But anyway, total variable cost is 150,000. So it leaves us a contribution margin for another 150. Be careful, this is not the same 150,000. This 150 is your total variable cost. Then the contribution margin is the revenue minus the variable expenses. Then the traceable fixed expense means only the fixed expense is held accountable by the television department. So they are responsible, or is only be traced. It happens only for the television division. If television is eliminated, all of this fixed expense will be gone. Oh, so it's really what I say, relevant cost and direct cost, okay, to the television division. So we deducted. So the division margin or segment margin is 60,000. So this new term, segment margin. Is not a contribution margin, is not net operating income, is a net income or the margin made by each segment, but not only deduct the traceable fixed expense. And then that's for the explanation and the difference between contribution margin and the segment margin. Now let's see the income statement for the company-wide and for the two divisions. Television, we already just did. And computer, they have lesser sales revenue, 200,000, then lesser variable cost and lesser contribution margin. The traceable fixed expense to the computer division is 80,000. So means this fixed expense only happened for the computer division. And they got a segment margin is 40,000. So by the division margin at the company wide, okay, at this line is just the adding of the two divisions. After the division margin, we deduct the common expenses, the common fixed expense. Those are happened for the overall company. So it's happened like the general manager's salary, or maybe the general depreciations, utility expenses. But anyway, this 25,000 wouldn't be eliminated if you get rid of the television or the computer by itself. Okay. But if you remove all, like both of them, okay, you can avoid, because that's probably you stop operation at all for the overall for the company, you eliminate all of the cost. But if, for example, if you only eliminate the computer, all of the computer data will be gone, the revenue gone, variable cost gone, traceable fixed cost avoid, no division margin, but this 25,000, most likely it will incur, and now it has to be deducted by the television's division margin only. So it's not a good thing, because if you keep the other division, it still can share some of the common expense when we look for the total net income for the company-wide. Right? And we want to evaluate the, so which one is doing better if you do the compare the television and the computer. Based upon the division margin, you may think, oh, television is doing better since it's earning a larger division margin. But be careful, their sales revenue is also different. So in that case, if you really want to compare, you should get a percentage. Oh, like we can use a division margin ratio. So 6,000 divide by 300,000. So if the rate for ratio, we can make a comparison. But if you only look at the division margin, the dollar value, you couldn't just say television is doing better than the computer. Okay. So if you can do this, so we can get a approximate. So the computer can get a 20%, right? So 20% division margin. But the television is also, oh, it's interesting. So you can see here, 360 is also 20% proportional. But at least in terms of the percentage or earnings, they are doing the same. But in case, okay, if you got a higher percentage or lower percentage, then you have a higher, doing like a higher performance than the other division. As previously mentioned, the fixed expense can change their category from traceable to common or from common to traceable, depending on the level of the segments you are looking for. So now if you continue to look for the television, further separate into two product lines. One is the regular TV, the other one is the big screen, right? So when you want to check more details for the television, you can further separate the income statement for the television to the income for these two product lines.